Alright, here it goes. My first video. I'm going to be explaining on what an option is. So, you probably heard of an option as a way to make money. And yeah, you can make money pretty fast, but you can also lose it just as fast. But you want to get into it, don't know how, don't understand it. I'm going to help you out by teaching you how to read what an option looks like, right? So, pretty much an option itself is just a contract that you have the right to buy 100 shares of a stock at a certain strike price. You have the right, not the obligation. When you have the obligation, that's called a future, right? When you have the right, it means that you have the option to go through with that contract or to sell it to somebody else, right? So, when you're looking at an option, there's a couple things you have to look at. Right here, we have on January 21st, 2022. Call option with a strike price of $50. The strike price means that you plan to buy 100 shares at a $50 strike price, meaning that if the price goes up, let's say to $60, right? Intel's right now currently trading at $50. You have the right to buy 100 shares at $50. Now, usually that never really happens, but we'll get more into that on another video. I'm just going to be explaining what this screen says right here. So here we go. The next thing we have here is break even. So by January 21st, if the stock Intel is above $52.50, you either broke even or made money. It's that. And here's the percentage that you would need it to go up in order to break even or make money. So as long as it's above 4.5%, you make money, right? Here's the percent change today. Today it's gone up 8%. Not bad. And here's the dollar amount it's gone up today. So it's gone up today $20. Now, wait a minute. It says 0.20 there. It says 20 cents. Right. Once again, you times everything by 100 because that's what the contract says, right? Each contract is times by 100. So we're going to be multiplying everything by 100. So this is actually $20. So if you look right here, this is not $2.50, actually $250. Now this right here is the price. It's also known as a premium. Premium is how much you pay to own this contract. Next up, we got the bid and the ask. So the bid is what people are buying this contract for. Right here, $2.48, and the ask is what people want or people are selling it for. So it's $2.52, $252, right? So the premium is somewhere smack in the middle, right? Right here would be $250. Mark is pretty much what the premium is at, also in between the bid and the ask. Previous close is what it's closed at yesterday. So tomorrow it's gonna be the previous close would be $2.50, $250, right? The high today was $250. The low was $212. So self-explanatory. Volume for today, meaning how many times this contract got sold and bought, was 4,479 times. Open interest just means how many contracts are not fulfilled. So how many contracts are either need to be closed, need to be bought, need to be sold, right? Implied volatility. Implied volatility actually goes hand to hand with Vega. So we're not there yet. We're going to skip implied volatility for now. And we're going to move down to the Greeks. So right here, when we're looking at the Greeks, we see delta. Delta actually goes by the price of the stock currently trading at. So for every dollar the actual stock goes up or down, that's how much delta is added or taken off from the premium, right? So if Intel goes up to $51, this delta right here will be added to the premium. So if Intel hits $51, your premium should be about $300, meaning you made $50 profit. Sick. Now these Greeks also change. They change day by day. They change hourly. They change weekly. They're constantly changing, right? But we'll get more into understanding the individuals on why they change, why they move so much later on. So gamma is pretty much the Pippin to Delta, right? It's the Robin to Batman. Sidekick, right? Gamma just states how much delta will be moving to every dollar added or taken off. So same thing. Intel hits $1, gamma gets added to delta. So now delta would be at about 62, right? So now that 62 When Intel's at 51, when Intel hits 52, $62 will be added to the premium. Now you're at 362, right? Around there. That's what gamma is. Once again, I will go into more detail on delta, gamma, theta, vega, rho, and later videos. This is a broad overview on how to read this and to give you some confidence. Stepping stone. Next, we have theta. So theta is just how much dollars you're losing on a day-to-day, on day-to-day, right? So right here, we're losing $1 daily from the premium, right? So let's say it does go up $1. Oh, dang, you made $54. And oh, tomorrow, you lost $1. So today's profit was $50. Sick, okay? That's what theta is, how much you're losing on day-to-day. So right here, it's $1. Vega. So we go Vega back to implied volatility. Vega just means how much implied volatility goes up by percentages gets added to your premium or taken off. Implied volatility increases. The more volatile your stock is, the more the premium goes up. The less volatile your stock is, right, the less opportunity there is to make money, the less people want to buy it, the cheaper your premium will be. And this is calculated right here, $9. Implied volatility goes up by 1%, $9, boom, added to the premium. Implied volatility goes down by 1%, boom, $9 taken away from the premium. So compared to buying stocks, options, there's a lot of ways you can make money. Not just betting it will go up, down, or sideways, but you can make money off volatility, and you can make money off theta, right? The same way you lose money, you have the opportunity to be on the other hand as well in order to make somebody else lose money for your profit. It sounds trickier than it actually is. It's really basic stuff. So if you have any questions, write me a comment. Next video, I'm going to be going into what buying a call is, selling a call, selling a put, and buying a put means. So thumbs up if you thought this was useful, thumbs down if it was useless, and yeah, appreciate it. Laters.